So there's this growing question circulating around COMEX silver right now. Where exactly is the physical metal everyone's supposedly claiming? The official data isn't providing reassuring answers. Look, I had zero intention of recording this today. I'm literally here half ready with coffee still in hand. But after checking the most recent warehouse and delivery figures, I realized you've got to see how this is unfolding. Today's February 6th in New York. Drop a comment telling me when you're catching this because I know tons of you watch these way after the fact. And honestly, I appreciate that. Listen, the typical media narrative around silver never changes. Either there's nothing happening worth mentioning, or they'll just say it's volatile and call it a day. But when you actually dig into the infrastructure, the delivery mechanisms, how much metal is available for actual settlement, the contract positions, something unusual emerges. It's not tinfoil hat territory. It's more like the numbers are getting uncomfortably close to each other. The fascinating thing about markets is that the real story usually lives in the tedious data nobody wants to read. Price movements grab headlines. Inventory classifications are boring. But when those boring categories start flashing warning signs, that's your cue to pay attention. Time-wise, here's what matters. About 3 weeks out, we hit the notification period for March contracts, specifically around late February, the 27th. That's the cutoff where participants either commit to physical delivery or they don't. This transitions from being an internet argument to an actual operational challenge. The calendar doesn't wait. I'll walk you through 3 components. First, the broader pattern of delivery activity comparing last year to the year prior, because this isn't some isolated monthly anomaly. Second, recent activity in January and February that suggests participants want physical metal immediately rather than gambling on future availability. Third, what we might expect during the March settlement window if a reasonable percentage of these paper positions convert to actual delivery demands. Let's establish the context. Last year's delivery volume was far from typical. We went from roughly 200 million ounces being delivered annually to something approaching 500 million ounces. That's not statistical noise. That's a fundamental shift in how the market's being used. What makes this particularly notable is the consistency. This wasn't driven by a single crazy month. Month after month, delivery activity exceeded historical patterns. This represents a sustained behavioral transformation. Now, you could argue there are innocent explanations. Maybe commercial entities adjusted their risk management approaches. Perhaps the exchange became a more attractive financing mechanism. Warehouse receipts serve as useful collateral in various transactions. All valid possibilities. However, when you examine the intensity of recent months, these explanations start feeling insufficient. For those unfamiliar with how this works, think of futures contracts as time-stamped commitments. The majority of participants use them purely for price speculation. They have zero interest in receiving actual pallets of silver. They just want market exposure and they exit before delivery becomes relevant. However, embedded within each contract sits a delivery clause that functions like a compressed spring. As the notification deadline approaches, participants face 3 choices: walk away entirely, roll their position into a future month, or stand firm and demand delivery. Rolling forward is standard procedure, essentially postponing the decision. Demanding delivery is the serious option. That's when warehouse receipts transfer, physical metal gets allocated, and the infrastructure must locate deliverable inventory. Why does open interest matter? Because it represents the potential demand pool. Think of it as everyone waiting outside a venue. Most won't actually enter. But if the venue's capacity is limited, you don't need everyone, just enough people to exceed capacity. This is why even moderate delivery demand creates tension when available inventory is shrinking. January typically operates as a quiet month, not a focal point for delivery activity. Yet this past January delivered volumes comparable to historically major months. We're seeing multiples of what January normally produces. Historical January figures sat around single-digit millions of ounces. Last year showed low double-digit millions. This January? Approximately 50 million ounces. That dramatic acceleration indicates preference shifts. Participants prioritizing immediate possession over future promises. February exhibited similar urgency. Within just the opening days, delivery volumes approached what February typically produces across the entire month. That's not ordinary market rhythm. That's participants scrambling for position before options disappear. January data showed February contracts representing roughly 20 million ounces of open interest. Within February's first few days, deliveries consumed nearly that entire amount. Not a portion, nearly everything. Under normal circumstances, only a small fraction actually stands for delivery, typically low single-digit percentages. When the overwhelming majority appears to be standing, you're no longer observing a futures market functioning as designed. You're watching a physical allocation line form. Futures markets operate on the assumption that delivery remains a minority preference. When delivery becomes the majority behavior, the system can technically still operate, but it fundamentally changes character, from trading mechanism to rationing system. Now we arrive at March. March represents one of the traditionally heavy delivery periods. Recent data shows March open interest sitting above 400 million ounces. Absorb that figure. Over 400 million ounces of contractual claims pointing toward one settlement window. This positioning is migrating. Some rolls into May, some positions close out entirely. Given January's delivery surge, evidence suggests certain participants accelerated their timeline, demanding immediate delivery rather than waiting for March. This departure from typical paper market behavior is significant. Simultaneously, May's open interest is building, signaling that even if March pressure releases, the underlying dynamic persists. We're observing stress points moving across the contract curve rather than dissipating. Obviously, all 400 million ounces won't convert to delivery demands. Markets don't function that way. Typically, most positions roll or settle financially. Here's the issue. You don't need anywhere close to full conversion to create operational stress. If merely 25% stands for delivery, that's over 100 million ounces requiring allocation. If 50% stands, you're approaching 200 million ounces. If the majority stands, the situation deteriorates rapidly. Supply side matters enormously here, though it gets ignored until crisis moments. COMEX warehouses maintain distinct inventory classifications. Registered inventory is what counts for delivery, metal specifically available for immediate settlement against futures contracts. Eligible inventory represents metal stored in approved facilities but owned by specific parties and not designated for delivery unless those owners explicitly authorize it. Recent registered inventory trends are concerning. Several months ago, registered stood around 170 million ounces. Early January showed figures in the low 100 million range. Late January saw further declines. Current snapshots place registered just above 100 million ounces. This isn't gradual seepage. This is rapid drainage. Timing amplifies the urgency. First notice for March hits around February 27th. We don't have months for reversal, we have weeks. Current withdrawal rates approximate 750,000 ounces daily leaving registered status. Over recent months, registered inventory dropped from peak levels to barely 100 million, representing close to 40% decline in delivery-ready metal. The drainage rate has actually accelerated lately. If this velocity continues through late February, registered could sit in the mid-80 million ounce range when March notifications begin. The setup becomes clear. Potential delivery demand, even using conservative participation estimates, approaches the same magnitude as available registered supply. Last year's March saw substantial deliveries. Simply matching that performance tightens the system before accounting for potentially increased participation rates. Let me inject some realism into the doom scenarios. Low registered inventory doesn't guarantee imminent default. Registered can change. Eligible can convert to registered if owners choose. External metal can enter the system. Futures markets include pressure release mechanisms. Participants can receive incentives to roll positions forward. Spread relationships can widen. Cash settlement offers can appeal to some participants. Systems often survive longer than anticipated. I'm not predicting guaranteed collapse. I'm identifying an unusually tight configuration that alters participant behavior. Regarding eligible inventory, current figures show just under 300 million ounces. Why not simply convert it? Because eligible inventory has owners. That metal belongs to investment vehicles, private holders, commercial operators, institutional entities. Converting eligible to registered requires owner consent to make their metal available for delivery. If owners perceive the market entering a squeeze dynamic where scarcity drives violent price movements, why would they volunteer metal at current terms? If you anticipate higher future prices, you don't liquidate positions today unless forced. Eligible represents potential supply, but it's voluntary supply. Voluntary supply behaves differently under stress conditions. Connecting the narrative threads. We observed broad delivery surges throughout last year. January showed unwillingness to wait for March. February immediately consumed nearly its entire delivery interest. March faces enormous open interest. Registered inventory is declining sharply. This combination explains the crunch terminology circulating. Possible scenarios. First, markets function relatively normally. Most March contracts roll forward. Manageable volumes stand for delivery. Systems handle the load because registered stabilizes, and perhaps some eligible converts. March creates tension but passes. However, pressure doesn't vanish. It migrates forward into subsequent months. Second, above normal participation demands March delivery. Registered appears thin. Markets respond with aggressive roll incentives, unusual spread behavior, settlement alternative discussions. Third, delivery requests meaningfully exceed registered supply plus willing eligible conversions. The exchange implements protective measures, cash settlement encouragement, procedural interpretations, processing delays, or confidence deterioration. Cash settlement carries emotional weight because futures contracts are marketed as standardized physical commitments. Long position holders approaching delivery expect commodity receipt, not apologetic checks. When markets begin suggesting cash alternatives, even if technically voluntary, incentive structures change. Delivery transforms into negotiation. Scarcity fears trigger increased delivery demands, creating additional stress, amplifying fears. Classic behavioral feedback loops. Maintain skepticism, though. Sometimes markets create these dynamics deliberately. Large participants pressure nearby delivery months to extract favorable roll terms. They don't aim to break systems, they aim to get paid for moving positions. They stand, threaten standing, unnerve short-side participants, then accept premium rolls into future months. This represents legitimate commodity market strategy. So the question isn't merely, is the system failing, but also, who profits from the appearance of potential failure? Even without technical defaults, confidence can fracture. Markets operate on collective belief. When sufficient participants doubt paper claims equal physical claims, behavior transforms. That triggers nonlinear price movements. Practical approach. Reject anyone offering absolute certainty. Monitor the unglamorous details, daily warehouse reports, registered trends, movement velocity, spread dynamics between nearby months, open interest migration patterns as notices approach. Remember why silver markets exhibit fragility. Silver functions as industrial metal embedded in electronics, energy systems, medical devices, industrial supply chains. When steady industrial consumption coincides with awakened investment demand, inventory elasticity isn't infinite. Physical supply chains respond slower than price charts. 2 questions for you. Will March become the breaking point, or does this push into May as the real confrontation? Will eligible owners actually volunteer metal if spreads go wild, or will they remain passive and watch the system strain? Share your perspective below. If you have access to physical market premiums locally, coin dealers, wholesale quotations, tell us what you're observing. Are premiums stable or climbing? Physical premiums often signal stress before futures prices react. 3 indicators I'm tracking. Does registered inventory stabilize across consecutive updates or continue declining stepwise? What happens to roll costs between March and May approaching first notice? Do deliveries maintain elevated levels even during typically quiet periods? Monitor those 3 elements to understand this situation faster than mainstream coverage provides. Real market crises rarely unfold cinematically. They grind, accumulate stress, bend gradually. Then occasionally they fracture, in moments appearing sudden despite weeks of visible pressure buildup. We're currently in the visible pressure phase. Watch late February closely. Track March positioning behavior. Pay attention to whether registered continues hemorrhaging or stabilizes. This is educational content, not financial advice. I'm not your advisor, don't know your circumstances, and I'm not recommending any specific actions. Conduct your own research, maintain reasonable position sizes, and don't let internet pressure drive decisions you'll regret.